My name is Maurice Radwan. I'm the head of Green Deal Infrastructure at Commerz Real. We are a Germany-based asset manager focused on real estate and renewables. My department is responsible for all the investments in sustainable infrastructure, including renewables. We manage 1.5 gigawatts of operational assets across Europe, across various jurisdictions. We also have 600 megawatts under development, and we invest across the entire life cycle of a project in the sustainable infrastructure space. Strong focus on renewables and onshore and offshore wind, but also working on battery storage projects and hydrogen projects. We consider buy and hold strategy to still be very relevant in this market environment because it requires a lot more technical and commercial DNA than you would need in the past to do renewables transactions in a buy and hold strategy. You still have the benefit that you would get from any large portfolio. So the scale basically allows you to get more efficiency, for example, on the O&M side, and you're more likely to squeeze out value on a portfolio basis than if you focus on the assets only in a very short amount of time. But the market has become a lot more complex with very volatile energy prices, volatile raw material prices, and massive supply chain issues in the past. And you need to be able to manage that complexity. Particularly being able to monetize kilowatt hours in the best manner possible is absolutely crucial, be it via PPAs or when selling to the market. But having a good commercial expertise, I think, is ultimately key in making the most of your investments in the long term. And ultimately, if you are able to build a diversified portfolio of high quality assets and you have the technical and commercial DNA that I mentioned earlier, you'll be able to obtain attractive risk-adjusted returns in this market environment. However, you should always be able to maintain the flexibility to reshift your portfolio by divesting assets or bringing in cheaper cost of capital to maximize your performance, even in a buy and hold strategy. From a returns perspective, agricultural PV and floating PV are interesting, but ultimately they also reflect the additional uncertainties inherent in both applications as they're still relatively immature. Agrisolar definitely has its appeal if you shift your attention away from pure returns for a moment and you start factoring in the impact aspect. Agrisolar can in some cases be much faster than conventional PV, as there's typically less opposition in the community. And in many municipalities, such projects get extra points in the evaluation when they have competing proposals on the table in the municipality. So you have a speedier process, and you have obviously more municipal buy-in from the community. Also, there are very symbiotic benefits of higher agricultural output and OPEX savings to avoid green cutting or potentially lower land lease costs. So there are actually multiple benefits to be obtained. On the floating offshore side, we do not see this particular offer to be a big benefit to investors, other than that it's broadening the investment opportunity set if you're interested in offshore wind. And at the moment, it still offers a different risk return profile compared to fixed bottom offshore due to the maturity of the floating technology. So ultimately, floating offshore, it just broadens the opportunity set. It is interesting from a risk return perspective, but if you look at it from a portfolio diversification perspective, it doesn't really add much compared to regular offshore wind projects. From a technological risk perspective, agriculture PV is much more mature because you apply basically technology that is already very commonly used in regular PV applications, whereas floating wind structure, for example, is much more immature and still needs to develop, very tremendously, as well as the O&M concepts around that. So really, agriculture PV can almost be considered a core style investment, whereas floating PV is really on the value add side. Very interesting from a risk return profile, but still, you still have to be wary to pick the right investments, the right partners, and really have a project, that works ultimately from a risk return perspective. There is still a lack of performance data given the limited amount of projects that have been realized to date, particularly in the utility scales space. There are obviously additional operational risks due to potentially higher soiling and coexisting agricultural activities that take place. So obviously there may be damages resulting from farming equipment or the activities that are going on there. So that's the potential additional risk that you have to be aware of and that you have to factor in when you operate. I mean, depending on the design of a particular agricultural PV application, you will also have higher capex. And for example, if you're mounting your modules up very high, you have to deal with higher wind loads than in usual applications. So there's an additional operational risk, which you have to factor in. factor into your decisions when operating, building and operating these projects. But all in all, we believe these issues to be manageable, and given all the positive benefits of agricultural PV that I mentioned before, we still think it's an investment class or investment niche that is very interesting for investors.